It's a shock order. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the president demands the banks cease this immediately, and you're not going to believe what the president is calling for and why. Plus, we have a sponsor of today's show. Bonsai International is back, and you want to check them out on the NASDAQ under symbol BNZI. And on June 10th, we featured Bonsai on this show, and 6 days later, their stock jumped 14% in pre-markets. It's since pulled back and getting ready for another big move as the company just announced record-setting results. Stay tuned to the end of the show or check out the pinned comment or description for a chart setup you won't believe. Now, let's over to Bloomberg, where he picked today's story up with the headline, as China steps up warning on relentless bond buying frenzy, now ordering the banks to stop buying bonds in a big way. And I'm going to show you why this is one of the worst moves Beijing can make, and yet they have no other choice but to do it, as funds investing in bonds will find it difficult to sustain the returns, which have exceeded 10% in some cases so far this year. The PBOC just said, as the yields rise, long-duration bonds will face larger risks of retreat in capital gains. This is an issue. Now, can you imagine what happened in the U.S.? Of course, banks bought a whole bunch of bonds and issued a mountain of loans at super low interest rates, only to have the Fed drive rates up to the moon and, of course, put the banks in a position of massive unrealized losses. Is this what's going to happen in China? Well, that's not the reason. Of course, the president is making this proclamation as we see that rates continue to decline here in June after, of course, the PBOC repeatedly has been telling the banks to stop buying bonds. And the problem here is these central elites do not understand that long-term interest rates are a function of growth and inflation expectations. There's reasons the banks are being forced to buy these bonds despite what the fact that the government wants. The PBOC has repeatedly hinted its discomfort over the bond rally in the past few months as long-term yields touched two-decade lows. And why this seems as good news, because lower yields means cheaper borrowing costs for the economy, they can also destabilize financial markets and derail the recovery should speculative trading grow. Now, that's not something you would ever hear anyone say, because usually low rates are actually happy things for consumers and businesses in the banking industry, because it leads to more borrowing. In this case, the PBOC continues to put out a warning directed by President Xi Jinping that the banks need to stop this. But the reason yields are falling in China has everything to do with their economy. And if we want to take a look at a chart that gives you an impressive setup and chance to make money, look no further than Bonsai International on the NASDAQ under BNZI. Here it is 6 days later in pre-market trading. The stock shot up over 14%. Now you see this red line. This is a 10-day volume profile. Buyers have been underneath here, and next time this thing makes a move, it's going to shoot higher. You can see it did it back here as it jumped, and it's done it before. I'll show you a bigger chart later in the show. Stay tuned for the more on that. As in another report late Friday, the newspaper said investors are underestimating factors such as inflation that may upend the bond rally. The recent trend of money leaving bank deposits and flowing into asset management firms in search of higher returns will only temporarily boost demand for bonds. And the real reason here has nothing to do with, of course, demand for bonds. Banks would love to lend. That's the issue. Banks make money, at least more money, lending. The problem is they have no prospects. And, of course, the economy there is getting worse. The banks have no other option but to buy bonds and buy long-term ones, as there are a few signs of the enthusiasm fading. The 50-year special bond auction last week drew solid demand, much to Beijing's disappointment, while 30-year government bond yields declined to the lowest level in more than 7 weeks. And what did we see here in the U.S.? We saw big demand for the 10-year, 30-year, and near record demand on our 20-year bond auction this week alone, as we see global investors starting to realize that central elites are making a massive policy mistake as the global economy starts to turn down, and that means rates going down with it. But the notion that inflation is the issue here, we'll take a look at the U.S. Consumer Price Index, shown in blue on a year-over-year rate of change against two-year Treasury yields. And what do we know? You can actually see yields declining, not just once, but many times as inflation continues to rise. So as the PBOC warns bond investors that, hey, inflation could be a problem for you, the reality is bond investors already know that any rise of inflation is only going to be transitory, because the bond market is already telling the markets that inflation expectations are declining, as well as economic activity. And the verbal warnings may put a floor on 30-year yields. At least that's what the government is hoping. But bond moves may be still biased lower in the absence of more forceful measures to halt the rally. And the issue here is, as China's economy continues to head toward a recession and all a crisis, yields are going to fall more. And the only evidence we have of that is not just the property market, but what's going on in the industrial sector. As China property drag is getting worse and factory output disappoints, and I want you to be thinking is, how do you revive economic activity in a debt-based economy if higher interest rates aren't working and rates at their current level aren't working? There's only one direction they can go, and it doesn't matter if banks buy them or not, as industrial production rose 5.6% from a year earlier, and retail sales even offered some encouragement, picking up more than expected. But Chinese shoppers remain far from recovering their pre-pandemic mojo. And why is that? Because as the world's second largest economy and the world's largest export-driven economy, when the world slows down, well, that means business in China slows, and consumers there know that because they see a lack of demand for their factories. That means they cut their spending too. And here you can see the link between industrial production and two-year Treasury yields is quite remarkable, because downturns in industrial production are often led, not followed, by a decline in two-year Treasury yields. And what this is indicating and suggesting in China is that, of course, if you want to revive the economy in a debt-based economy at that, you need lower yields to spur demand and consumption. In this case, Beijing is saying, look, we don't want lower yields. And the reason they're saying they don't want this is because there's a huge discrepancy between U.S. yields and Chinese yields. And the problem is money's leaving their country, which is something they don't want. They want money flowing into their country. It's headed into the U.S. bond market because investors have the safety of U.S. Treasuries and a higher yield. And that's the problem Beijing is facing. It's the exodus of money. And the numbers add up to a still weak recovery. Most economists likely requiring more action from Beijing to boost consumer demand and tackle imbalances if this year's 5% growth target is to be met. And again, you come back to, how do you get consumers to spend money in a debt-based economy when higher interest rates don't work and current rates aren't working? Well, they need to go lower. And Beijing says, well, we can't have that because more money would leave our country. And you see the problems here, and it only gets worse. And that could take the form of a stepped up government spending and heightened efforts by the central bank to put a floor under the housing markets and get credit flowing. But that's the naive belief, is that the government can spur demand. It doesn't work that way. You can get transitory moves in the economy when governments spend large amounts of money. You want your economy to move, and you need consumers to drive it. And here you can see the effect, of course, on yields and lending. This comes back to the banks, because we talk about how the banks are buying bonds because they love to lend to the economy. That's how they make money. If the economy is sliding into a recession, the banks don't want to take that risk. Consumers don't want to take that risk. And here you can see, again, coming back to the U.S. data, here we have the commercial industrial lending. This is published every week, shown in blue on a year-over-year rate of change. And you'll note that decelerations and outright contractions when the blue line is below that horizontal black line in commercial industrial lending means rates are going to come down. And oftentimes rates lead a decline in lending. And again, if current rates aren't working and you want to spur demand, well, you need rates to go down. And the problem here is, if we look at the U.S. data, what we see very clearly is the market believes rates need to stay high and elevated, and we're already just slightly above an expansion. And if this turns down again, well, it's dangerous news all around. And the most disappointing in May's data from China is probably that property sales barely saw any improvements after so many supportive measures. This is something I said would happen, that it would not work. In fact, some believe that they need to find new ways to lower the rates on existing mortgages. Well, how do you do that? Well, you let interest rates go down, closing the gap with the cost of new ones. So you see the issue that Beijing's facing here. Their economy is entering a contraction, and if you want to spur demand, you need lower rates. The problem is lower rates are causing an exodus of money. So what do? Well, they don't have any answers because the property market is about to blow up again as Chinese home price slump accelerates despite more stimulus because it's not working. Again, the global economy is too weak, the Chinese economy is too weak, and nobody trusts the developers. As you see, new home prices in 70 cities, excluding state-subsidized housing, so 0.71% from April. Here's the big reason: the most since October 2014, and now the sharpest decline in terms of value of existing homes since at least 2011, if you can imagine that. And China last month unveiled a broad real estate rescue package to address the biggest cloud over China's economy, relaxing mortgage rules and encouraging local governments, get this, to buy unsold homes, if you can imagine. And they have since rolled out major easing for home buyers, slashing down payment requirements and allowing room for cheaper mortgages. And yet it has not worked. We said it wouldn't work. And what you're going to see now is the Chinese economy continue to head into recession. Rates that are going to fall. Money is going to leave. Eventually, rates here in the U.S. are going to come down in a meaningful way, as weaker than expected home prices suggest that the measures haven't improved home buyers' confidence. Again, it's not about confidence. It's about the economy. And this is what people don't understand. Consumers buy homes when they feel they can make the payments and they have the chance that they're going to be able to make the payments. When they're more worried about their jobs and their existing bills and debt, well, they're not going to buy a home, especially when they look at the property developers who are practically insolvent and can't even get homes finished for people to buy. Why would you buy a home? It makes no sense to me. And funding for developers has stayed weak since the government drew up a whitelist of property firms that are eligible for loans late last year, and a broad gauge of financing for these developers, including loans, bonds, and proceeds from home sales, continue to shrink heavily, down 24.3%. So the solution Beijing came up is we just need to load the developers up with more debt so they can get properties finished and consumers will want to buy them, when they can't even see, yes, they do need to get the developers in a stabilized state. The issue is still coming back to the global economy and the Chinese consumer, and they are not confident at all because they see everything slowing down. And this is why the PBOC is now looking at new tools, because they don't want to see rates fall, and look at what they're perhaps going to do, as this could lead to a big shift in how Beijing itself manages money. The PBOC chief said it also that the Monetary Authority, along with the Finance Ministry, was studying how to implement government bond trading, if that's not interesting, noting that it would be a gradual process, seeking to dispel the idea that the central bank was embarking on massive stimulus. No, if they're going to get into trading, what they're going to look to do is dump bonds on the market to try to drive rates up. Now, that makes this interesting, as including government bond buying and selling into the monetary policy toolbox doesn't mean we'll do quantitative easing. It means they're looking to get rates up because Beijing's threats to the banks to stop buying bonds isn't working. It's not just the banks are buying bonds. It's not the issue here. It's the fact that the economy is slowing, and the bond market is a function of that, and is saying, look, rates need to go down. The problem is Beijing doesn't want to do it. And it's not just because money's flowing out. It is also to do with the yuan. And the remarks come as expectations are growing for the PBOC to start purchases and sale of government bonds after comments by President Xi Jinping made public this year called for such a tool to regulate liquidity. However, there have been few details on how this may be done and when it may begin. Again, these are all threats to the banks that they're going to try to drive rates up. The problem is they can threaten and do what they want. It's not going to work. Because now we can see, despite the fact that rate cut calls grows, we see tests to resolve, to defend the yuan, and this is coming into the forefront of what the real issue here for the PBOC is. It's all about the currency. And they face a dilemma as this main rate tool for supporting economic growth could also hurt the yuan, which has slipped 2% against the dollar so far this year. Earlier cuts by the European Central Bank and Bank of Canada would provide more room for the PBOC to follow, allowing borrowing costs would also align with Beijing's push to stimulate domestic demand. So you see, experts are saying, look, you need to cut rates and you need to do it now. And for good reason, your economy is in a recession. And of course, President Xi Jinping and the PBOC are saying, no, the problem is if we cut rates more, even more money will leave our economy and it will destabilize it. I want you to understand this is a lose-lose situation. No matter what they do, they've monkeyed with their own economy so much that they're going to send it spiraling into recession regardless of the moves they make. Because economic fundamentals of highly uneven economic growth, deflation, and weak credit demand warrant lower interest rates, which I agree with completely. Of course, what we know is something that's going to warrant more demand is, of course, the stock for our sponsor for today's show, Bonsai International. You can find them on the NASDAQ under symbol BNZI. Let's take a look because they transform cold leads into engaged buyers. And based on the chart setup, they're going to transform some people's brokerage accounts into the green. As we look here, they released record-setting mid-year customer satisfaction results as they've demonstrated unwavering commitment to excellence for the year-to-date 2024, as they've achieved outstanding net promoter score of 53 and an exceptional customer satisfaction score of 96.1. These remarkable metrics underscore Bonsai's dedication to exceeding customer expectations consistently, and this means their customers are overwhelmingly satisfied with their experience. And in addition to this, they've honored to receive the prestigious CMS Wire Impact Gold Award in the Customer Journey Innovation category. And what this is leading to is their innovative approach has significantly optimized customer journeys. And here's a big part: increased net revenue retention. And this is getting the attention of investors because as we look at their stock, we saw that 10-day chart with a volume profile where it's trading right at that, looking to break out. And has it done that before? Well, as we zoom out to the 30-day chart, what we can see is anytime Bonsai stocks gets into this current level, buyers step in, and you can see it's jumped 1, 2, 3, 4, 5, 6, 7, 8 times, setting up another big move that you can take advantage of, again, on the NASDAQ under the symbol BNZI. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.